actually funds, right? They're actually structured products you're putting together. They're wellbore only. Are they rated? Is there a management team? What happens if I invest into them? Am I now getting the interest deeded directly to me? Do I have to manage the minerals? Are you going to manage them? If it's working interest related, do I have to pay my percentage of OPEX? You guys have, I'm throwing out all the different things I may be considering right now if I'm listening, because in theory, it all sounds great, but then there's a lot of little details that can complicate it and make it go off the rails. You guys have, done a lot of work to structure something and package it very, very clean so that the investor is getting yield and getting a monthly distribution that's net of everything. So let's really lift up the hood and explain the mechanics of what this actually is. It's a Reg D offering, correct? So a lot of folks will be familiar with that. Just break down the nuts and the bolts of it.
Yes, it's a Reg D offering. It's a 506B, and it outwardly looks very much like a fund. It's an LP-GP structure. Donovan Ventures is the GP, but you don't get the LP interest buys the assets and then sells down units into its fund. The fee is simple, like Victor said, it's not 2 and 20. We're charging a little over 10 bips or about 1.25% annually on the NAV of the asset. And again, it's meant to be extremely low load to the investor. It's meant to be very mutual fund like, where there's daily marks. I think again, transparency and what that asset's worth is hyper important in today's world, especially as you see what's going on in the real estate space. But then also, I think differently is if you think about what you're buying a pool of production, and we're selling pieces of that pool every month through depletion and production. And so that investor, a typical package is going to generate probably 20 to 30% of its investment back that first year. That second year is probably 15 to 20%. That third year is it's very high income association to the point you get payback in sort of a 5 to 6 year period. Again, depending on the production profile and the cost structure.
Yeah, and because it'll be a liquid market, what is the lockup period? You mentioned there's one initially.
It varies, and this is regulated by the securities market, but it's a year for the most part. There's depending on your investment size and affiliate definitions that can change, but for most part, it's 1 year.
Yeah, no, it's interesting. Victor, you were walking me through some slides yesterday, kind of comparing a typical real estate investment that's more development heavy, and it's really backloaded, right? Your exit and everything is where you're getting majority of your return. The reason you guys are focusing on unconventional is that flush production type nature of the curves, right? And so you mentioned getting, you're more front loaded on getting your cash back, which is interesting for certain types of investors who want to maybe stay in it for 3 or 4 years and then monetize and then do it again and kind of roll their investments over. It's an interesting concept. And